Hello, fellow Rebel Capitalists. Hope you're well. Wanted to summarize the week in the stock market. We have had a ton of volatility. So let's dive into this article from CNBC and figure out what happened and then try to figure out what will most likely happen going into next week and into the future. So stocks fall on Friday to cap tumultuous week of trading from new scariant threat. And I want to point out that, yes, it is true. The stocks were down on the day, I think about 50 or 60 points, but they started off the day up probably, I don't know, what were they, Josh? Up 200 or 300 points? Yeah, they're up probably 200 or 300 points, and they went down 2 or 300 points, and they finished down about 50 or 60. So we're just seeing this massive volatility. Josh was telling me today throughout the afternoon, the VIX was getting up over 30. So that's, 35, he's saying. So that's definitely a big deal. So stocks dropped on Friday after disappointing jobs report as the market wrapped up roller coaster week driven by the scariant. And I don't know if it was driven by the scariant or if it was more the stock market seeing what the bond market has been warning us of over the past 6 months. And those of you who just watched my video with Jeff Snyder, you know exactly what I'm talking about, or maybe more specifically, the euro dollar futures curve. And if you didn't watch that video, check it out, then you'll know what I'm referring to. But the bond market has basically been telling us that we should expect another recession and that economic growth or economic activity globally will decline over the next 6 months or a year. It will definitely not increase. So maybe this is the stock market absorbing that. And is that decrease in economic activity a result of the scariant, or maybe the government's response to the scariant, or maybe their response to using the scariant as an excuse to achieve their objective? Maybe a little more likely. Who knows? Let's keep reading. The Dow Jones Industrial Average fell 60 points, dragged down by a 1.9% loss in Boeing. 30 stock index was shown down more than 30 points early in the session. Yeah, we talked about that. Okay. Tech stocks among the most notable losers on Friday. Now, this is interesting. Tesla fell 6.4%. Zoom video declined by 4.1. DocuSign down 42%. Whoa, I didn't see that. Holy cow. 42% in one day. See, this is the danger, isn't it, Josh? I mean, we were talking about this. When did we talk about this yesterday as far as my strategy compared to uh, my good buddy, Meet Kevin? And it's just, again, I want to be very clear. There's not right or wrong. It's just you first got to understand your personality. And I'm someone that is very risk averse in my investing, with my entrepreneurial ventures, and maybe what I do in my personal life, racing cars. You could argue I'm not risk averse at all, but definitely with my purchasing power, my savings, I am. And DocuSign's a great example. You could be holding that and doing fantastically well over the past 6 months. I mean, I have a chart in front of me, but just using this as a hypothetical. And then bam, one day you're down 42%. You're just getting hammered. And think if you have that on margin, you're getting a margin call, you're getting crushed. And then do you buy the dip? Does it go down further? That's what we were talking about. The psychology of how the retail investor tends to lose money because they're just naturally, your emotions get involved. And it goes back to that saying that the stock market takes the stairs up and the elevator down. And this is how the average Joe loses so much money when these markets get so frothy. And I'm using that term very mildly, of course. When these markets get in these massive bubbles, that the Fed and the government are blowing more and more air into by the day. But so, I mean, just imagine the difference between having DocuSign and then owning XYZ commodity producer or XYZ oil company. That's something that I would buy, or Coca-Cola for that matter. Never are you going to see that go down by 42% in one day. I shouldn't say never, but you know, probability is incredibly low. So anyway, I guess they missed fourth quarter sales guidance, or this was lower than what analysts expected. Boy, they are punishing the stock. I mean, my goodness, it's got to be just way off the mark. But my point here is that if tech stocks are going down, you would assume that means that interest rates are going up, or that's what the market is expecting. But the bond market is saying something different. But I think you could have this environment where they might not be expecting higher interest rates, but they're expecting a slowdown in the economy or less economic activity, which would make sense. But then if that's a result of the scariant, then it's kind of curious as to why DocuSign and Zoom are actually going down. Because if what the markets are telling us here is that globally we may see more lockdowns, what we're seeing right now in Europe, then you would assume that Zoom would go higher. So it's kind of an interesting paradox here. Stocks tied closely to the cerveza sickness have led the market on its week-long seesaw, and that continued Friday. Companies that benefit from the economic expansion, like hotels, airlines, led losers. So you got the Carnival down, Delta Airlines down, cruise ships, casinos, all down, which would indicate the market is seeing, or the stock market is now seeing what the bond market has been telling us for the last 6 months. November jobs showed slower than expected job creation, or I like what Schiff says here. It's not really job creation because you're just bringing back the jobs that the government destroyed back in 2020. So non-farm payroll increased by 210,000 for the month, well below the 573 projected. However, unemployment rate fell to 4.2, better estimates of 4.5. Right, but that's just because that's a horrible number, because that if we expected 573 at an unemployment rate of 4.5, we got 210 and unemployment rate went down to 4.2. That means the labor force participation must have plummeted, even gotten even worse than it already was. So that's a very bad number. Even though the CNBC would sit there and say, "Oh, great, unemployment went from expectations of 4.5 down to 4.2." It is unsettling to see that we're unable to build on October's strong numbers with uncertainty only set to see increase in winter progress, said Steve Rick, chief economist at CUNA Mutual Group. That said, it is not completely surprising that this month fell short, with the country preparing to respond to the new scariant and continue to battle rising inflation and ongoing supply chain disruptions. But yeah, again, this is what the bond market has been telling us for the last 6 months here. And just like I said in that conversation I just had with Jeff Snyder, everyone kind of just focuses on inflation, deflation, or disinflation with the bond market and the gold market. And I think it's maybe more accurate to see that yield curve, or the treasury curve, predicting economic activity first and foremost, and then try to layer on top of that what might happen with consumer prices. I think that's, at least in my mind, that's how it makes a lot more sense. That the bond market over the last 6 months isn't necessarily implying that prices, that we're going to see deflation, where your groceries are going to be cheaper in the next 6 months. I don't think it's saying that, but I think it is screaming at the top of its lungs that economic activity globally will be decreasing. And that's, in my opinion, what the stock market is most likely picking up on. I don't know if I'm sure it has a lot to do with the scariant, but or maybe it's the government's most probable response to the scariant will lead to that severe decrease in economic activity. And that's what the curve is telling us. So just going back to the market volatility, which is massive. Friday down, last Friday, down 900 points. Monday up 236. Tuesday down 652. Wednesday down 461. And this is a day that we had epic intraday volatility, because I believe at one point it was up about 500 or 600 points, and then just completely collapsed at the end of the day, down 461. Thursday, way up 617. And then today, again, huge volatility, up 300 or 400 points, down 300 or 400 points, end the day at minus 60. So I think the main takeaways from this market activity is, number one, when we discussed this with Tony Greer, he was saying that he believes this volatility will most likely subside next week and in the weeks to come. I don't know. After my discussion with Jeff, I'm definitely on the fence, because I think there is a very, very good argument that the stock market could be facing some significant pressure to the downside as a result of, or this, based on this predictive ability of the Eurodollar future curve. So I really wouldn't take one side or the other, but it would not surprise me at all if the stock market really has some problems over the next few months. Then, of course, the question is, what will the government or the Fed's response be to that? And we'll just have to, I guess, cross that bridge when we get there. All right, guys, enjoy the rest, or enjoy your weekend. Enjoy the rest of your day. I guess it's Friday. That's awesome. Always remember to stand up and fight for freedom, liberty, free market capitalism. And we'll see you on the